Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. I greatly appreciate all the subscribers, all the viewership, and all the comments down below. Thank you so much. Today, we are going to look at GameStop. GameStop has been blowing up recently as the internet has gone after the GameStop to try to vanquish the evil hedge funds who short it. Good luck to them. That's fantastic. I'm glad people are getting in the stock market. I'm glad people are using technology to find good companies they want to buy and then go buy them. Good for you. Keep going. What I want to do is take a look at GameStop historically and see what is the company's financial situation and why the hedge funds might have been short in the stock to begin with. And then think, okay, maybe there's a turnaround here and we can fix this company and grow. And what would it take to grow to justify the current price? That's kind of what I want to do. I don't need the hate mail about ragging on GameStop. That's not what this is about. I want to look historically why a hedge fund may have shorted it, and then what, if anything, could be done with this stock to really produce a fantastic return. So let's go dive into it. The first thing I want to show you is what behind me is a bit of history. So this is Volkswagen in 2008. Which was the victim of a short squeeze, much like GameStop. And at the time, there was a large short interest in Volkswagen. It spawned a giant buying spree, which was the short squeeze, and it became one of the most valuable companies in the world for a single day, only to come rocketing back to earth as the market settled out and eventually came about where it was, before the pandemonium. So this is, I think, a little rational, long-term view of what can go on in the market from day to day. And let's try not to get caught up too much in the little flashing number that we see on the screen. But really, we all work for our money every single day. And if we're going to put it to use, what are we buying? We want to know that what we're buying is going to last for a long time. So let's take a look at GameStop and move right forward. So here we go. Here are the financials for GameStop over the last 9 years. 2011 to 2019, revenues $9.5 billion to $6.4 billion over this time frame. And you can see this is probably one of the reasons why it's a negative growth rate, 5% annually. And it's kind of being a victim of Amazon, right? It's everything's going online. I think they were a little slow to transition. That's why they got a new CFO, a new CEO, kind of out with the old, in with the new. Let's turn this puppy around. And I like those turnaround stories. If you saw my IBM video, I do like that opportunity. So this is why I think one of the reasons you're seeing selling pressure is the business model itself is being fundamentally threatened. The next thing is EBITDA, is our measure of earnings, right? EBITDA, $840 million to $111 million in EBITDA. That's a negative 22% annualized growth rate. Pretty consistent over that period of time. I'm actually, frankly, I'm shocked that the board of directors allowed the former CFO and CEO to remain employed as long as they did. That is an awful track record. And when I look at the P&L, we can look at it here now, actually, and there's a lot of costs in here that are really just hurting the bottom line. Yeah, so here's the P&L for GameStop. You can see the 2019 fiscal year. Net sales, $4.5 billion. Operating loss, $400 million negative, right? But there's a write-down, a goodwill impairment of $363 million, which was a charge, an expense for assets they had purchased historically. They were sitting on the balance sheet as assets. When they looked at them and did an analysis, they realized, well, these aren't really worth what we have on our books. We have to write them down. And that's a one-time charge. It did happen twice. It looks like a bad investment that they tested once, wrote down, tested again the next year, had to write it down again, which is also bad. That could continue to go out in the future. I don't know. But what I do want to talk about here is this negative 400 million is basically this write down. So you add this back, you get a zero, which is zero earnings for the year. Do the same thing in 28. They've got 18. They've got $700 million of a loss, I add back the almost $1 billion of write down, and you get maybe a $300 million profit, but it's all lower than it was 3 years back. So it's definitely declining no matter how you slice it, even if it's EBITDA or operating profit with a little adjustment. They're definitely having a problem. Let's go look at the balance sheet and look at debt, look at enterprise value and market cap. Here's our debt. Debt has definitely increased recently as they, as this type of a loss puts such a cash squeeze on a business that they really had to go out and borrow a little bit of cash to keep the fuel in the fire. And I think that's also part money that they're going to use for the turnaround that they're trying to execute. They need cash to go do that. If they have to go buy something, if they expand their leadership council, hire new employees, that cash will be consumed. Market cap, shares outstanding times price gives me market cap. And you can see this market cap is absolutely obliterated from $3.2 billion to $259 million. I think that's a steal, frankly. I mean, I know that it's deteriorating, but at such a low price, it's almost worth buying just to throw a little cash at it. I wish I would have bought it earlier, quite frankly. Enterprise value has fallen commensurately, even though the debt has expanded, and the enterprise value here is 13 times based on this falling EBITDA, and the debt level is 10x. So it's definitely a struggling company. They're going to have to raise both equity and debt. I think, given where the stock has gone, I could see them selling stock into that to raise some cash. Couple other things. Let's go look at the cash flow statement. So if we come back up here, we'll just walk through this. I think there's some good operating lessons here that we can apply to other businesses. So this is the cash flow statement. Remember, first third is operating. That's what they generate their cash from the business with. It always starts with net income. That's the net income you saw from the other statement. And it basically adds and subtracts what is or isn't cash from this number. So the first thing you're going to see is that goodwill impairment charge that we covered earlier. Right, they add that right back because it's not an actual cash cost. So this number goes up plus. Perfect. The other thing I wanted to bring your attention to is here, merchandise inventory, a positive number, a very large positive number. What does that mean? Basically, they're selling all their inventory and they're not rebuying it. A normal cadence of a business, you sell and you rebuy inventory. And the positive of selling inventory, turning inventory to cash is a positive number. And the negative of buying more inventory to replace what you sell normally means that this number is a zero. Or if you're growing, it's actually a slightly negative number because you're always buying a little bit more inventory than you're actually selling as you get larger and larger. But here what they did is they said, hey, we need cash. Let's start liquidating inventory. So stop buying, only sell produces a positive one-time large number. This is not going to be maintained. They're going to have to go back to something like this where they're buying to replenish all inventory. But it's a nice way to gin up cash when you're short and you need money right away in a business. Next thing is this number here, accounts payable. This is their vendors. This is their cable bill, their rent, their employee comp. It's generally not employee comp because that's up to date. This is like legal bills, insurance, all the vendors that they have to pay for product or for services. This is the bill that's like, get the service and it's due in 30 days. The aggregate of all of those contracts is this number. So the reason it's so large, so negative is they bought down a lot of old bills. The cool thing is that's probably a one-time deal because generally you have a pool of bills that you owe. You buy it down. You don't have to buy it down every single year. It's a one-time hit to cash, and it looks like they used some of old inventory to offset that. And it's part of their turnaround. They're trying to clean the business up. They're thinning inventory out. They're going to scale down units to find the most profitable retail locations, keep those, sell the rest. And I think what they're doing here is they're cleaning up the business, which is good to do. Aside from that, there really isn't a whole lot of extra cash. Now, this particular year, they don't make any money. That's minus $400 million of cash that they lost. It's essentially zero if I take these two numbers back and add them back. It's kind of like steady state It's zero free cash flow with a zero profit. But if they can fix the business, there's actually some room there, which I kind of like. Because this number, I'll go back to my other sheet, we'll do cash now. This number here, the CapEx number that they that they have to put back in the business isn't all that big. Once they build the store, I mean, it doesn't cost them much to build a store, but the store itself is fairly profitable. There's a pretty good margin here, especially if you go back in time, right? This CapEx doesn't get that much bigger, but this number can vary widely if they're selling a lot of product. So I would expect them to have to put some cash into the business. So this number is going to have to go up, I think, especially if they're having to buy an online business or move the business online. They're going to take a lot of cash to do that, so I would think this number is going to go up. But there's room here, and the margin seems to be pretty wide. The debt here is kind of a wash because, yeah, they took on a lot of debt. You have no idea what they're going to do in the future. Not much you can do about that. The free cash flow number is largely negative, kind of a disaster. Again, it's a turnaround. It's not going to produce cash, so you can't really value or buy it based on cash. What I do like, however, is the share reduction. Look at this. These guys have been chewing up shares. If you bought a share back then, you're one of 136 million shares, and currently you're one of 66 million shares. That is outstanding. That's a 10% drop. These guys have been generating cash for a long period of time here. Yes, it's declining, but it was positive, and they had to do something with it. So they bought back their own stock. My opinion, they should not have done that. They should have invested into the digital enterprise that they're now building after they've had this problem. But that's one of the problems. But it was neat to see them pull back a lot of their shares, as I guess they thought they were severely undervalued. Their stock range here, in my opinion, was only really undervalued here. This range was pretty fairly valued. But that's one nice thing is there's very few shares outstanding right now. Yield, I don't think you can trust that because the cash flow itself is so wonky. So what do we want to do with this? I can't help but look into the market and say, what is this company going to do? I have no idea. I mean, to be honest, I look at this and say, where's the stock trading right now? I've got $325 per share. The way I would look at this is forget cash flow for a second. Forget the timeless. Let's say in 10 years from now, this company is going to grow, that they are going to take their now new robust stock price and they're going to sell equity into it to raise a little bit of cash. And I have them raising $1 billion in this model by selling just a few shares, frankly. At this price, they don't have to sell that many. So I said they're going to need an extra $1 billion to help them turn the business around. The stock itself, I said that they can sell it at $150 a share. Again, I have no idea where they would, at what price they would be able to get this done because it's so fluid. So I said $150. That means they need 6.7 million new shares to be issued. It's only about 10% more shares than they currently have. It's not that big of a deal. But that extra $1 billion in cash gives them a lot of money to go do their turnaround, which is what they need. The next question is, what do we want to do with growth? Right? It can't be zero. They got to do something. They're currently at $111 million of EBITDA. They used to be back in the heyday, $840 million. So they got to get back there at least. So the question is, what EBITDA do they need to be to justify the current stock price? So if I'm here, $325, I'm going to pay $325. I'm going to toss that up here, and I'm going to exit at some price. We're going to set this in a second, such that over this time frame, I get a return that is a market return. That'd be a 10% return. We're going to fix this in a second. Now, let's go do that. If I take this, my EBITDA forecast, and say, okay, last year's number is this, kind of a fluke, right? They should get back to whatever they need to do. What rate do I need to assume? If I said 10% annualized growth rate over here, 20 times enterprise value EBITDA, less a little debt, gives me a market price of $60 a share. That's well short of the current $350, $325. So I'm going to move this up again, $25, 25%. That gives me a $186 stock price. Certainly a nice stock price, but still nowhere near where it is right now. And that's 25% annualized growth rate for a year. Let's go to 45%. Almost 50% growth every single year. That means EBITDA is $3.1 billion in 10 years. At 20 times gives me a $710 price target. Now let's put this in our IRR calculation. I buy the stock, $325. I hold it for 10 years. There's no free cash flow because they're investing everything in the business that they need to grow to execute on their plan. They execute on the plan, they get $3.1 billion of of EBITDA in 10 years. You get a 20x multiple on that, and you get your stock price with some other adjustments I'll go back over. That's $710 price. That gets you a 9% IRR, which is a market return. So now what we've done is we've just used the math to produce a result. Now let's smell check to see if we think the result is right or not. So we got a market return by buying the stock now. We have a growth rate that we have applied 45% annualized to $3.1 billion in 10 years. Is that possible? Sure, anything's possible. I think that's more than top line revenue. No. Yeah, top line revenue at the heyday, and then falls to 3. So it's about half of revenue currently that they need to produce in earnings in a decade. So the idea here is, I don't know what the number's going to be. Nobody does. At this point, the stock is trading literally just on the ticker on the screen. I don't think anyone's buying it for a business case. What I'm trying to do here is make a business case to justify the price that's in the market. And to do that, I believe you need to assume roughly 50% annual growth rate on earnings over a decade, with long-term visibility to about $3 billion of earnings out a decade and a decent EBITDA multiple. If that's what you believe is going to happen with the cash that they raise, the extra $1 billion of cash, of shares that they sell, that they have the jack to do it, go for it. It's a great deal. If you don't believe this growth rate, or you'd rather put your money into something else that has a more conservative growth rate, go do that as well. It's a free market. You guys can do whatever you want, which I absolutely love. And I support anybody who's willing to step into the market, put their hard-earned money against any stock. Go for it. That's fantastic. This channel, what I've promised you and what I look for is a grounding in actual cash flow. That's how we value. So unfortunately, I'm not going to be able to give this an opinion. I'm going to give it a meh. Because honestly, I have no idea where it's going to go. The thing could go to 1,000. It could go ballistic, just like Volkswagen did. I have no idea. And as a result, I can't put my hard-earned money against it. I can't certainly suggest that you doing the same. So what I'm going to do is I'm going to sit back, watch what happens. I'll go buy something like a Lockheed Martin or something else and eat my popcorn, collect my cash dividend, and just wait for the market to fix itself. Thanks for watching GameStop. My name is Cameron Stewart, CFA. This is Rational Investing. If you like the channel, hit the subscribe button. We've got lots more videos coming up. Check out the channel for all the comments. There's lots and lots of great stock recommendations down below. Thank you very much. Take care. Bye-bye.